Hello, Baker International Finance students. So we're on week 3, and actually after this week, we're already halfway done with the course. So good job with the forum discussion this past week. Just make sure to stay on top of things. And as I said, this course moves very quickly. So this week, we're going to look at chapters 7, 8, and 9. Continue with your homework. And if you have any questions, email me on the homework. But hopefully it's pretty straightforward looking at some of those templates. And then, continue to engage in that forum discussion. So I have some notes here, just kind of look through this week. First, to start off with Chapter 7. And I want to let you know, I put a link out there to the Khan Academy videos. I think it does a good job of helping explaining such things as futures, options, different derivatives. Just pick and choose what you're interested in watching. I think it just gives a good explanation. The textbook. This week, they're shorter chapters, but they can be some technical reads sometimes. So if there's one particular one that you find interesting, whether it's, the futures or the options, just view that. He does a good job, just short little videos, gives some good visuals to help explain those items. So first off with derivatives, the reason multinational enterprises want to use them is to hedge themselves. They want to protect themselves. With any type of derivative, it means that its value is derived from some underlying asset. So as long as you have the asset, you can use it to hedge. But if you don't have the asset, you're just purely speculating. And it's almost, the extent the textbook warns us, you're gambling. So, unless you have money to lose, you probably don't want to get into an option or futures contract unless you have some type of underlying asset. It'd be like the wheat farmer. Not actually having the wheat and going out and engaging in the futures market. At least with the wheat, he knows that he can sell the wheat. And he's usually buying in some type of futures contract or in options. So make sure that he's protecting himself from price movements. Same thing is done by multinational enterprises, either through currency or protecting themselves from interest rates. And that's what a lot of these chapters talk about. So, all right. So just kind of first start off with the idea of a futures contract. I'm just going to go briefly through some terms and ideas that present in this chapter. Futures contract, basically you're taking a bet which way you think that position is going to move. They also mentioned the idea that a futures contract, you have to put some initial deposit down in a margin account. If it moves in your favor, depending on which position you took, they will add money to that account. If it moves out of the favor, they will take money away from the account. If it moves too out of favor, you're going to have to do a margin call and put more money in the account. The idea with futures is most people do not actually deliver the goods or services. It's going to be more that they do an opposite transaction and close that futures contract out. All right, ideas, if you go short, you're betting that the price goes down in the future. So if you're betting on a particular currency that's going to drop in value, or if you go long, you're betting that price is going to go up. And they give some examples in the textbook. With options, the nice thing about options, think of it as like an insurance contract. So a call option gives you the right to buy. So say that you know that you have to make a payment in euros 6 months from now. I can do an option now with a call to make sure I lock in a particular price. Or put, if I know that I'm going to receive euros 6 months from now from an investment, I want to convert those to American dollars, I could have a right to sell it at a specific price. The thing about the options and the option writers, they're going to write them where they hope the majority of them are going to make money. It's just like an insurance contract. When you have insurance for your home for a fire, insurance companies know that not many homes are going to have a fire, but there are going to be a few that do. And if so, they're going to have to pay out based on those contracts, but most of us will not ever cash in from our house burning down. Hopefully we don't have to. But the textbook talks about the exercise price, the stock price, and at the money. So once the option starts gaining value, it becomes in the money. So, say, for example, originally the spot price was, say, some commodity $55. And you had a right to buy it at $57. Well, now if it's trading at $60, it's in the money. But if the price fell, say down to $40, you would never exercise that right to pay for a higher price for it. So the option just expires and it's worthless. So, but you'll read a little bit of the quotations in that chapter about the different options. Put, I want you to think about the right to sell. They're going to go through similar things, whether it's in the money or out of the money. And then finally, they talk a little bit about option pricing and valuations, the intrinsic value of the option. There could also be time value. So in addition to what's original just stated price, as a time period moves on and expectations change about the price of a currency, that can have some value in it as the value changes. So, okay. Let's see if there's anything else in that chapter. They talk just a little bit more about price sensitivity, so we read that. So, chapter 8 starts to go into interest rate risk and swaps. So, as a multinational enterprise, we're concerned about the cost of borrowing. Do you borrow in domestic currency? Do you borrow in the foreign currency? And they talk about the concept of credit risk and repricing risk. So the credit risk is that your company's position worsens, and then when you go out and you reissue new debt, the cost of that credit goes up. The repricing risk can also be that, that as debt matures, that cost of borrowing can go up too. So you're going to read a little bit about that. They talk about sovereign debt issued by government. It has taxing authority. That's going to be the lowest cost debt because it has that backing. If Ford goes out and borrows money, there's no guarantees it can pay it off, but at least governments, they can always pay that money off by printing more money. All right. Concerning this chapter 2, you're going to address interest rate risk, either with your assets or your debts. Potential different borrowing. You can have fixed borrowing or floating. Like, for example, I have a second line of credit on the house. It's a floating rate, and interest rates have gone up this year, and it's cost me more. So it was a risk I took. But previous years it was very low rates, so I benefited from them. So in order to manage this risk, certain firms may participate in ways to protect themselves from these fluctuations. So they may engage in interest rate futures or forward rate agreements. So with bonds, there's an inverse relationship to the price of the bond and the interest rate. So if I'm concerned about interest rates going up, bond prices are going to drop. So typically when you take positions on these, you're betting on which way the price of that bond is going to go. This chapter talks about swaps too, the idea that maybe one party is willing to swap a fixed for a floating rate for various reasons, and you'll read more about those examples, but they can be done with interest rates or currency. All right, and then the last chapter, chapter 9, kind of wrap things up this week. You're going to go more into theory about FX rate determination. You've been exposed to this in some of your previous chapters already, but you're going to get more into theory about going back to that purchasing power conditions, the balance of payments approach, the monetary approach. They even kind of mentioned some technical analysis. I would say most in the finance field and academia are not big fans of technical analysis because it's based on trends and charts and when things are changing. We're more in favor of fundamental analysis, but we have to recognize it because people do it. So they look at trends. Also, they discuss some of the current market interventions in market, either direct intervention, indirect, or capital controls. You're going to read a little bit about the Asian crisis in '97 and the Argentine crisis 2002. And then finally, the ability of forecasting in practice in section 9.4. Discussion of econometric models and whether markets are efficient. So it gives you a little bit of overview for the week. Otherwise, enjoy the week, and I look forward to talking to you online. Take care.